What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. The Federal Reserve has once again reached a new record with the size of their balance sheet as they just in the last couple of days passed the $7 trillion mark. That's right, their balance sheet is now over 7 trillion. Before the coronavirus hit, it was under 4 trillion, which puts their balance sheet on pace to hit 10 trillion by the end of the year. Clearly, there's no big deal. This giant increase and the speed and magnitude of the increase of this money supply is no big deal. This can't have unexpected ramifications in the economy. Sure. So today I just wanted to make a short video to show how the expansion of the balance sheet of the Federal Reserve contributes to an increase in the money supply and consequently an increase in credit, and why the idea exists that stimulates our economy, how it contributes to credit expansion. Let's dive in. Okay, so you know what a balance sheet is, right? A balance sheet shows your assets and your liabilities. So a personal balance sheet, on your liabilities side, you might have your car loan, your student loans, credit card loans, your mortgage. And then on your asset sides, you might have your stocks, your 401k, your savings account, the actual value of your home that you own, the value of the cars that you own. So you've got your assets on one side and the liabilities on the other. Now, for a person or a business to increase the assets on their balance sheet, the first thing you have to do is earn money somehow. You have to get income, or you have to take out debt, right? So you have to have an influx of cash that you can then deploy to purchase an asset. Now, most Americans, when they use debt, they use that debt to buy a liability. That's what keeps most Americans poor, is that they're borrowing money, paying interest on that money, and what they're doing with that money is buying something that is itself losing money. Buying a new car is a perfect example of this. What middle-class people usually do is they don't touch debt, but they use income and savings to buy things that they think are assets. Usually it's stocks, putting money into mutual funds, their 401k. And what the rich do is they usually use debt to purchase assets. And so they're borrowing somebody else's money, they're paying interest on it, and they're buying an asset that's producing enough income and cash flow to service that debt. And so with both businesses and individuals, there are limits to acquiring assets. You have to have an influx of cash, which either comes from income and cash flow or it comes from debt. The Federal Reserve, on the other hand, has the legal monopoly on creating dollars. Now, if you could use your home printer to print out dollars, I'm sure you'd be buying assets all day long as well. So what the Federal Reserve does is they print dollars digitally. They have the only legal monopoly on creating dollars outside of credit expansion, which is how banks create money. And so what they do with these dollars that they create out of thin air is they buy assets. Now, most of the time these assets are debt, and most of the time this debt is the United States government debt. They print money and they purchase treasuries, which is really just a fancy way for the United States government to be able to spend money that's newly created. They're not borrowing it out of the economy. They're not borrowing it from foreign economies. They're borrowing it from somebody who just printed it and created it out of thin air. It's basically like the United States government has a credit card with no limit, zero interest, and no minimum monthly payments. That's essentially how the mechanics work out, because when the United States government has their debt come due, they just take out new debt in order to pay off the old debt. And more, all of this debt is being owned by the Federal Reserve. There are still other owners of treasuries, but by and large, the only net new buyer of treasuries these days is the Federal Reserve, and pretty much everyone else these days are net sellers of treasuries. And when interest is owed on treasuries that are owned by the Federal Reserve, that interest then, those profits that go to the Federal Reserve, all profits are swept back to the Treasury. So essentially any debt that the United States government owes through treasuries that is owned by the Federal Reserve is interest-free debt, because all those profits are swept back to the Treasury. Now, other times, the assets that the Federal Reserve purchases are things like mortgage-backed securities. These are the instruments that caused a lot of issues during the '08 financial crisis. You have a lot of people get a mortgage, you have a bank take all the mortgages, put them together into something that's very similar to a mutual fund full of stocks. And so now you have this fund that's made up of thousands of mortgages. You put that mortgage fund up for sale to a bunch of investors, and so everybody that buys a share of this mortgage fund has the aggregated performance of all of the mortgages in the fund put together. Yes, this is still how that operates today. And so if you look at what the Federal Reserve has been purchasing recently, it's mainly been those two things. It's been mortgage-backed securities and treasuries. Treasuries, no surprise, the government is spending more money than anybody can even comprehend. There's obviously no natural or real person who's in their right mind going to loan that money at lower than the inflation rate to the government. The only net new lender to the United States government right now is going to be the Federal Reserve, who can print money out of thin air in order to buy assets. It also makes sense that mortgage-backed securities are the other thing that they're mainly buying right now because mortgages aren't being paid right now. Tons of mortgages are in forbearance right now. Tons of mortgages just are not being able to be paid, and so they're being defaulted on. And so the banks are having to unload these mortgage-backed securities to the Fed. Now, in a market without an entity like the Fed, these assets, these bonds, these treasuries, these mortgage-backed securities, any of these assets would have to rely on the actual market. And so if this asset comprised of a bunch of mortgages turns bad, nobody's going to want to buy this from me. The only way they'll buy this from me is if they can buy it at a really cheap price, because it's not worth the full price. It's going to have defaults in it. It's not going to produce to the seller the amount that they buy it for at full price. It'd be like if a stock like Apple, let's say, they're trading close to $300 per share right now. If all of a sudden it came up that they had tons of debt issues and they owed a lot of money and there was a lot of fraud going on and they had, there was a bunch of embezzlement and, they had lots of financial issues. Well, the free market would no longer purchase shares of Apple at $300 per share. It would start selling for a steep discount, maybe $200 a share or $100 a share. And then the Federal Reserve would come in and they'd say, well, we don't want that asset price to go down because it could hurt the people who own Apple shares. So we will buy shares of Apple at $300 per share. And so anytime these mortgage-backed securities, these treasuries, these bonds are purchased by the Fed, it's in an attempt to keep those asset prices inflated because they become a buyer at a price that the market would not be a buyer at. Now, a lot of these assets are held on the balance sheets of banks before they're unloaded to the Fed. Now, the balance sheet of a bank looks the same as any other balance sheet. There's assets and there's liabilities. Now, what did we talk about at the beginning of a video? If you want to be able to buy new assets, you have to either get new debt or you have to have income. There has to be an influx of cash in order to buy new assets. So if a bank has an asset on their balance sheet that becomes worth a lot less, well, if they then go and sell that to somebody on the open market, their cash influx is going to be tiny compared to what their asset value was. They're going to take a big loss on that because they probably bought it for close to its full value. But when they sell that to the Federal Reserve for its full value, because the Federal Reserve becomes the buyer of these toxic assets, they get an influx of cash of the full amount. And so then these banks can take that cash and they can do other things with it. They can keep that cash in reserves, they can lend that cash out, or they can use that cash for a small reserve of the total debt that they are loaning out, total money that they are creating by lending out more than the cash that they hold in reserves. Similarly, when the Federal Reserve buys treasuries from the United States government, that newly printed money goes from the Federal Reserve to the primary dealer who bought that treasury from auction. And then that primary dealer bought that treasury from the government. And that government, they sold that treasury, which means they borrowed cash. And then they use that cash for spending. And where does government spending go? Well, it goes to salaries, number one, of all the government employees. It goes to businesses that they make contracts with. And so no matter how you look at it, the Federal Reserve's balance sheet expanding is monetary inflation, is expansion of the total money supply in the real economy. Now, a lot of you right now are thinking, yeah, but what about debt defaults, bankruptcies, restructurings? All that is deflationary. From a monetary perspective, yes, that's true that there is monetary deflation there, and that's the primary evil that the Federal Reserve is trying to combat when participating in monetary expansion. They're trying to offset this. The problem is it's not offsetting it directly most of the time. You have monetary deflation and contraction over here met with monetary inflation and an expansion of the money supply over here. So there's real differences in winners and losers in this scenario because you have the losers who lose their ability to spend that money, who get the contraction, who get the losses, but there's different players who get an equal amount or more of new money to play with. And so just because the economy and the system overall is able to maintain the same money supply or grow the money supply, that doesn't mean it's the same players who keep the equal amounts. There are different winners and losers. And yes, like I've talked about in many of my videos, this actually contributes to the wealth gap. The losers are usually the poor and the winners are usually the rich. It's primarily asset prices that receive the benefits from this. And so asset holders, usually the rich, right? Because the poor people don't own assets. By definition, they're poor. And if you remember from my last video about what's going on with the rise of China, the fall of the United States, this is one of the biggest markers of a decline in power of a nation. Wealth gap's increasing because it's due to irresponsible fiscal and monetary policies, which are themselves results of decline in power and people in power trying to maintain it. That is a dry run, a quick primer on how the expansion of the Federal Reserve's balance sheet operates, the mechanics of how that money gets out into the economy, and how it actually creates real monetary expansion and leads to inflation in the economy. Thank you so much for watching. I really appreciate you guys. If you liked the video, please hit that like and subscribe button. It really does help out the channel. You guys have a great day.